So we are building a new fund called Campus Fund. We've been sort of on this since 2020. Started off with a pilot fund just to test out whether this model will sort of work in India. Right? So our focus is to invest in current students and recent graduates. Right. So the entire thought process is there's a lot of innovation happening across campuses. We don't do idea stage. We do sort of MVP, pre-revenue. We're okay with that. But we want to be the first institution, right? So started off in 2020, as I mentioned. Pilot fund that's done well. On the back of that, we've raised a second fund now that's about 100 crore fund. And we're deploying from that right now. Right? So three sort of stage investors want to be the first institutional check, and we typically lead rounds. That's sort of a quick introduction, but more about it later.
Hi guys, so I'm Aashish. I'm currently working at Mirae Asset in their growth to late stage PE. So actually, in a way, the opposite of what Chiranjeev is doing, more late stage pre-IPO companies. Before Mirae Asset, I was in fact working with Koreel at a fund called Media Development Investment Fund. So I've been on the investing side since 2016. I completed my MBA from ISB in that year.
Hi everyone, I'm Koreel, and again my experience is very different from both Aashish and Chiranjeev. So I started my career before digital was a buzzword. So I was part of the first internet radio that was ever built out of India called Music Curry in Pune. It was largely targeted at NRIs way back in 99-2000. After that, I kind of did complete shift in my thing and I moved to equity research. And then I moved into strategic investments, first with the Times of India group at the very unit that Aashish just talked about, Brand Capital. After that, I did a stint of, you can say, advisory work on my own before moving on to Media Development Investment Fund, where I'm currently overseeing investments and portfolio across Asia. So we have various vehicles that we invest out of. Mostly we look at seed plus to pre-series A kind of range, largely looking at content tech, and anything that kind of comes under the purview of impact investing using media and content technology as the route towards it.
In 2012, 2013, when I sort of networked with the ecosystem, a friend of mine was in the VC ecosystem, right? And he said, hey, why don't you come join me? And so sort of similar to what maybe Aashish mentioned, or just the network, right? Someone sort of reached out saying that, hey, this is an opportunity, maybe you can come and explore. And I was like, why not, right? It's a trajectory I want to sort of understand. I've been on the startup side, I want to see how the investment side works. So that was my first sort of formal entry into the investing ecosystem. Did that for 3.5, 4 years and realized eventually I want to set up my own fund. And yeah, then I think during ISB, so Richa, who's sort of the founder of Campus Fund, and I, we met. She's an LTS grad, but yeah, that's how it was an eventuality, and now it's just back here.
Super. Do we have any questions till now? I would like to keep it like a dialogue, not a monologue. So in case any questions, please feel free to ask those. Can we move ahead? So now, sir, the next one is like, what are your notable investments till now? Like, which are the key ones which you really like want to share with us? Yeah.
Yeah, maybe from some of my older days, possibly names that you folks would know. One is Moonshine, which is the meals startup. We've done Noto ice creams, that's on the healthy protein-based ice creams. Shop Kirana is again, if you folks have heard of it, so sort of a similar model, right? B2B Kirana store sort of management there. I love consumer brands, yeah. So I've done something called Go Desi, which is Indian confectionery. I've done a lot of these, and through Campus Fund right now, we've done actually a fair few investments as well, right? So something called Expand My Business, again early days, but raised their Series A, Series B from Alphabet, Franklin, and the likes. We have a recent space tech company called Diganta that's raised from Sequoia Peak 15 now. But it's just a host of different places, but these are the ones I sort of want to talk about.
So I can sort of speak about the kind of investments we've done in Mirae Asset. So which ones we're really proud about. So we do think that Car.Dekho, which is a used car selling platform, will do very well. In fact, it's don't quote me here, but of course the company is well on its way to an IPO, hopefully 2025. So we see that as a good comparison to a car trade or Carvana, Car Zoo. So the used car market in India, as we all know, is in fact even bigger than the primary car sale market, and is growing almost at a CAGR of 80%. So basically Car Deco fits right up there in the top quartile of performing companies in this space. The second one that we will know, and I'm sure you already know the name, is Big Basket. That is backed by Tata Digital, and so with that in mind, again, at least any kind of what you see or basically hear nowadays with corporate governance issues in startups, so that is definitely not the case in a company like Big Basket, because it's backed by Tata Digital. So obviously corporate governance takes precedence in terms of the key criteria when Tata invests in any company. So that's what we also hope will be a good outcome for us, because Big Basket again is a really interesting company which has actually spread its wings across different facets of the e-grocery space. I mean, it's not just a simple, you've got quick commerce, you have hyper local delivery, you've got like slotted delivery, you have subscription models. So in fact, Big Basket tries and dabbles across all these particular segments. So I think they have a good playbook which I think is working very well for them, and they've garnered almost 25% market share. So we are also proud of that as an investment. But we also have, on the other hand, Byju's. So I think I'll leave that for later. But these two companies definitely we think would be exits in our portfolio in the next 2 to 3 years.
Yeah. Fantastic.
I would like to talk about 3 of them. The first one is I did long back, 2013 or 2014. It's in the semi-luxury space. So I don't know if you've heard of the brand Giordano and Swiss Eagle. These are bags, belts, watches, etc. So typically, not very exciting to look at when you look at the business plans, because they don't have hockey stick growth as the tech companies show you, but extremely stable, extremely predictable revenue and margins. So very satisfied with that one. Then we have something in recent times called Onion Dev Technologies, which is basically a voice-based social network for rural India. Again, a very, very powerful concept and model, and which has really picked up well. Company's been growing almost at 15 to 20% every year, and for the last 4 years it has been profitable also. So what else do you want in rural India, right? So you really don't see these models appearing quickly. And the third one, which I would say is the really good one that I'm really proud of, is called Joe Stocks. I don't know how many of you have heard of it.
Yeah.
Very powerful model again. Basically, riding on the entire life cycle of a youth. So first you motivate the youth, then you skill the youth, and then you kind of get the youth to apply those skills in a real life environment. So again, parts of Joe Stocks, if you split it into different segments, are already profitable. So we are also very happy with that.
None of you have spoken about Web3 and AI. It's very, very surprising. Any reasons for that? Because those have been the buzz segments in the last 3 to 4 years.
Yeah,
I have a very good answer, but you
sure. So actually, I did mention there was one investment that we've also done. It's called Fundraising, which is basically a cricketing NFT platform, right? So they basically had raised their first round, the Series A round, which was $100 million round, at a post money of $300 million, and this was a proof of concept, typically. So obviously they've got a very good team. They had the the ex-team of IPL, I think the CEO or something of that sort. So they are basically now the founding team of this company. But we have seen it closely, and since I think basically Mirae is a global organization, so they've seen how these technologies have developed in the other markets such as Southeast Asia or even Europe for that matter. And they've seen that there was a kind of if you're taking blockchain, if you're taking NFT, if you're taking crypto, for example, right? These had performed in those markets, and they were very interesting investments from their vantage point. But now India is seeing that craze happen, but they also think that eventually it's going to meet its fate in some way or the other, because you've not seen acceptability from a customer standpoint necessarily, right? I mean, if you're talking about things like NFTs, you can only tell me how many people do you see here or anywhere outside who actually have an NFT with them or have actually sort of purchased one? And it takes a lot of explanation, it takes a lot of understanding that maybe that asset can eventually have value, but there's no sort of derivative of that. There's no kind of understanding of this as such. I'm just taking one example, of course. So when it comes to AI again, I think the global markets that we sort of interact with have seen, companies they've invested in, but have not yet seen large outcomes yet happen. Frankly. So from an India standpoint, they're a bit on the back foot, at least from our like Mirae asset standpoint. I think I'll put it that way. Maybe Campus Fund has a different view, or I guess Koreel as well. Sorry.
One follow-up question.
Yeah.
So is it a case of investors wanting to invest in that area and not seeing promise in Indian ecosystem, or is it something that they are going to wait and watch for the space itself?
I would say wait and watch is
The space
approach.
is-
So yeah, because again, I think any investor would, any particular early stage investor also would see as to how like this market may have evolved outside of India. I would say primarily. I mean, even if you see like Sequoia, the way they've also been investing. Honestly speaking, we've also heard the papers and just seen the news that Sequoia China had competing investments with Sequoia India. Right now, P15. So basically, the idea is that you need to see if these models have developed outside of India. And I think if you ask me, India is still nascent to this space. But yeah, I think investors are waiting and watching to answer the question. So.
We have one in Indonesia which is using AI pretty well. It's called Hukum. It's a legal SaaS company, and but again, we haven't seen success yet. So you have to put yourself in the shoes of the investor. Our fiduciary responsibility is also towards the funds we have raised from the LPs. And at the end of the day, at the end of the fund life, we have to return those funds with a certain IRR, right? So the investor mindset is obviously to be looking for ideas and whatever management success, etc., which kind of ticks several boxes. Now, if it doesn't tick several boxes at the beginning, it doesn't mean that we have thrown it out of the window. Maybe we will just keep waiting and watching, which is what Aashish was explaining. But in India, we are now kind of trying to see, there is one called JustBath.ai, which is again in the AI space, which is creating really good, viable solutions for all the content companies. But early days, we don't know how that business model will evolve, how much more uptake in customer acquisition, etc. That is not yet proven yet. But having said that, we also have something called a ventures fund where we kind of write very small checks, maybe sub $100,000 kind of checks for experimental business models, where and you can see that it's a tiny check, so we might be willing to kind of take that outsized bet that okay, we might lose the money or we might make 10x and nothing in between.
Which was the firm you mentioned?
Just Bath.
So I think from an early stage perspective, right, we are expected to be more risk taking, more open to new ideas or new sort of technologies coming in. Having said that, Koreel put it amazingly well, right? We have a fiduciary responsibility to return capital and win sort of returns. Keeping that lens in mind, right? We are always looking at new technologies, but you'll want to, even though we are very risk taking, you'll want to sort of be a bit more nuanced to it, right? So specifically towards blockchain or AI, as you mentioned, maybe I'll sort of get AI out of the way because, as you mentioned, these are buzzwords, right? The problem is AI or now generative AI in itself cannot be a mode, right? So if you're saying that this is my mode, it's not truly a mode, right? How you're leveraging that to maybe build layers over it is what we're trying to explore. So having said that, maybe we'll do our fourth sort of AI or generative AI investment from this fund itself now, right? We've done 3 already, we are looking towards the 4th. But they are not directly sort of AI companies. They are leveraging AI or Gen AI for different use cases, right? One maybe is more towards productivity management, productivity and meeting management, right? How do you get access to all your data across an organization quickly and sort of get those insights and out of the way, right? So multiple different applications are what we're looking at, and understanding that over that layer of AI, right? What are you building? Does that become a mode? Because technology evolves a lot more rapidly than you can imagine, right? Every other day, it's getting disrupted in itself, right? So tech is the biggest disruptor of tech, is what I would say. And it happens at a rapid pace, right? Same way, blockchain or NFT, crypto, broadly those buckets, right? I think NFT is saying from a consumer perspective, consumers having picked it up, right? That's a very consumer basic market. Until unless that happens, they don't understand an underlying asset or value behind it. It's tough to back a company, right? Crypto, similar way, there's a lot of regulations attached. Foreign markets understand it well. There is sort of a lot of activity happening there. But even your largest companies can take a fall because of the regulations, right? We've done gaming companies, real money gaming companies, huge market in India, right? Consumers are flocking towards it. But every other day I'm speaking to the company and there's some regulatory change. Another company got served with a legal notice. Someone just recently got served with a 1,500 crore sort of legal tax notice, right? It's absurd, but you're getting served with those notices. So we are sort of mapping all these spaces. Maybe blockchain has a use case, right? But it's not a new technology. Blockchain has been emerging for almost the past 8 to 10 years now, right? Banking was supposed to have a use case by now. We've seen supply chain. I've seen supply chain use cases back in 2015, right? Great use cases. But we're trying to look at maybe more infrastructure approaches, things of that nature, right? Not you could put it in multiple layers and try and sell it and package it, but you need to understand what is the use case or application. That's what we sort of try and understand.
So whoever is sleeping and like energized. Yeah.
I have a question for Mr. Koreel. Can you all hear me?
Yes.
A bit louder, please.
Okay. So as you mentioned that the semi-luxury brand and the tech. So the semi-luxury brand, the growth is very slow. So like, what according to you might be the reasons for the slow growth and tech booming so much? So definitely we know tech is booming, but what could be the reasons for these brands for a slow growth?
I mean, tech, if I say tech, then there is a platform kind of business that tech normally lends itself to. And that lends itself to network externalities and therefore growth begets growth. With semi-luxury, obviously growth does not beget growth always. I mean, you have a very finite market in which you operate, and within that finite market, you try to upsell services, goods, etc. So in that finite market, you will always be able to grow your revenues in a predictable fashion or at least stay on par with inflation growth, but you will always make margins. So as an investor, you have to kind of look at your trade-off. Like, do you want rapid growth but really crappy margins and very poor business model? Or do you want okay-ish growth but fantastic business model and predictability of margins and revenues? So that's where the trade-off happens. And always you'll find that companies which are able to have that predictability always have better cash flows. And when you have better cash flows, you can take risks in innovation. And you are not then held hostage to somebody else's whims and fancies of somebody who's giving you capital for growth or debt for growth. So if you can fund yourself, that's the best scenario. And therefore, then that makes the business even more attractive.
So typically when we sort of get, and obviously we get a number of investor decks as you guys would imagine. So typically when we start looking at, let's say an early stage startup, we would have to understand whether this company has, whether they have a product market fit. Honestly speaking, I think that is a very undervalued thing, but it's a very important, criteria to consider, at least for an early stage investor. And actually, I'll just take a step back. We at Mirae have also started looking at early stage bets. So like Series B, Series A is also something that we started looking at. So we get a lot of early stage decks. So I think product market fit should definitely not be ignored. The other thing that we also sort of look at is if the company is actually understanding the kind of space they want to operate in, and then understand who are the current incumbents, if at all, in that, right? You have to understand what kind of market share you can garner, as well as if that is a market that is also growing, right? You don't want to be in a market which is, let's say, kind of saturated and you are another sort of Me Too player. So I'll give you an example, right? We've been seeing a lot of D2C companies coming about, and D2C is a buzzword, which I guess was a buzzword, may not be this year necessarily. Maybe you can also correct me on that. But we've been seeing enough and more decks of companies who are in the beauty and personal care space, let's say. But the kind of differentiating points would be either in maybe the product they're offering. For example, maybe we're looking at a brand which is into, say, vegan cosmetics. So it's like animal free, animal cruelty free, basically using organic substances and all of that. The price point is, I would say, mass premium, not necessarily very mass in that way, not very on the higher end. But But you have to understand what are the current incumbents anyways operating in the market and what kind of market share they have, and if it's still growing. So you want to analyze from that viewpoint whether you can actually make a dent and increase your market share as well going ahead. So if that could be a mode. So that's what I'm coming to. The mode has supposed to be spelled out in your deck in some way or the other. If you're doing something different, if you're doing something very innovative that the others may not have considered. Third, and I cannot obviously overemphasize this, is the strength of the team. I mean, as silly as some people say, it's very cliche, but you have to give a lot of credence and importance to the team that you've set out. Because at an early stage, typically it's guys who have met each other in a college, or basically have been friends for a couple of years and are deciding to start up after their college, or maybe a couple of years of experience in a particular, let's say Flipkart guys have now decided to start something else altogether. So I think that is something very important. You need to have a strong team. Fourthly, I think it's very important to sort of exactly spell out your business model. In a lot of decks that we've seen, it gets very complicated to understand actually धंधा क्या है, right? आप लोग दिखा रहे हो कि समझो something like, for instance, I saw a deck of a company in the space tech space, right? It's very niche, very extremely niche. You need to have all kind of government contracts. You need to deal with Indian space organizations, ISO sort of, and so we were trying to understand kya hai dhanda exactly, how you're making money here, right? So that is something which I think is very clearly to be shown in the deck. And lastly, I think what is important is do not spell out your valuation or expected valuation in a deck at all. I don't think that is the right stage to do that, right? Typically say where you want to be, right? Let the investors or let maybe let's see the other competitors also, because typically when we are investing, we are going to be looking at the transactions that have happened in the space, so we can come out with a number, or maybe a lead investor will come out with that number, but let that go in the process. Typically, do not I know that you can obviously spell out what you're looking at, but don't have a particular number of a valuation in mind, if you ask me generally. And a lot of people get very excited to even spell out an exit for the investor, and that is something which should not be done, because that is in a way off-putting, because how can you decide an exit for an investor? And 90% of those don't even happen. I would go so far to say 99% of those don't happen, honestly speaking, at the stage at which we are at. So that is something that I think is important to look at. Other points will come to me as we go along, but I leave it to
I think, Aashish, thanks, you covered most of it. So I have a typical checklist of 5 items. One is, of course, market and the space that you mentioned. Management comes a close second, and it is very important, since we are all early stage investors sitting here. I think that has highest weightage, even if you get your market right, etc. But if you don't have the management right, I would immediately forgo the deal. Third is product market fit, and where is the product in its current stage of evolution? How close are you to launching it? If you've already launched it, how has been the acceptance, etc. Fourth is revenue profile. How concentrated is your revenue profile on 2 or 3 areas? One is it concentrated in the hands of a few clients? I'll feel very jittery getting into that. Is it non-recurring revenues? As in, do you have to spend money to get revenue every time? Again, red flag. So I would say, if your revenue is diversified amongst clients, especially if you're B2B, and if your revenue is recurring without you having to spend umpteen number of dollars just to get $1 of revenue, these are your sweet spots. And it should be obviously in a market that's good. Then is the strength of the deal. I think Aashish was alluding to that in the last part. The strength of the deal lies in 2 or 3 facts. Is that how attractive is it compared to peers? Can I, as an investor, figure out what are the closest peers to this, and in my mind make an assumption of where this deal should be in that space? As a founder, it is your job to make my job easier. If you can provide me good competitive sets, data about them, or point me in the right direction, I would like to see that. Because by you doing that, it also shows you how aware you are of your own competition also. And one thing we don't like seeing is that this is the first time this is being built. It's not true. Everything has been built before. Okay, and I don't have competition. No, it's not true. Everything has competition. So I think if you can manage those parts and expectations, you'll be fine.
Yeah, no, I think similar points, but for us, maybe because we come in a shade or a step before these funds, right? We have very early investors, pre-seed series where we typically come in, right? So I'll broadly call it as 3 buckets. Typically something you would have got, right? So founders, market, and product or business, right? Probably actually in that order of weightage as well, right? So for us, because we're coming in that early, we want to make sure we're betting on the right set of founders, right? Because for us, it is, you're going to be discovering your business while you're building it as well, right? We are very okay with coming in at that stage. For us, we're very comfortable with business models evolving over a period of time, right? PMF may or may not have happened. We look at some semblance of a PMF, but it can evolve, right? Because consumers are constantly changing. If you look at B2B, technology is constantly changing, right? What you're building today gets disrupted tomorrow. Like GenAI disrupted a lot of different things. So then companies have to figure out how can you leverage that and then just sort of evolve your platform of business as well, right? So for us, PMF, you'll find you'll evolve with it over a period of time. That sort of comes a little secondly. Founders, why we typically sort of index on heavily, right? We sort of come in early. We build about a 18 to 24 month runway with our portfolio companies that we want to lead those rounds. That typically means you might see failure along the way. Can you bounce back from failure or not, right? A lovely example I prefer giving very early on in investment days, right? We co-invested with Ratan Tata and a top tier VC fund in a company. Founder was your typical IITian sort of profile, right? Top ranker. When I say top ranker, he was AIR2, so IIT Bombay AIR2, right? Not saying anything of that sort. Basically meaning always used to success, right? He's been the top caliber founder, and that was what a lot of our backing was on. Things go down, startup life is sort of tough, right? If you don't go in the right direction, things can go south. But how do you respond to that sort of event? How do you come back from that, bounce back from that is something you map, right? So seeing failure for first time in your life at that point in time, you can either crumble, you can bounce back. Unfortunately, he crumbled, which is fair, right? Which happens, not taking anything away from that. But for us, it is, can we figure out are these the right folks who will be able to bounce back, right? Very recent thing in our current portfolio, we 5 co-founders sort of building a company, almost got acquired, and then that acquirer just said, don't quote me on this. Acquirer said that you're not worth anything, I'm not going to acquire you, shut down the company and join me. Right? We spent 6 months with the company and now they've raised from global VCs. Right? So it's just how do you respond to that situation, bounce back, and this is just an example of why we index so much on founders, right? Can we work with them? Can we build with them? We want them to build on their own, right? But wherever we can add in value is what we look at. Right? The second, as Koreel also rightly alluded to, is what the market is, right? How one big is that market? You'll still discover what are you operating in. But in most cases, if not all, someone or the other has already tried to build something similar, right? And our typical question, if you're saying no one has built in this, then our question is why has no one built in this, right? Like we keep asking ourselves that and the founders that if you're saying no one has built in this and we can't find someone, why has no one done this before, right? So either it's not the right space to build in or it's not really a problem, which means you're solving for a problem that doesn't exist, right? So it's either that case or if someone hasn't built, very rare cases we'll come across something saying that there's actually no one who's building it and you've landed upon something, right? There is potential for that, but very rare cases, right? So you want to understand what is this market, what is the landscape, can you actually build a differentiation or a moat and come out and make some market share for you, right? And the business and product for us, at least personally or from a campus fund perspective, it will evolve. We are coming in very early. We are expecting you to sort of discover that, build that along with time. These are 3 broader buckets. Pricing for us, how we price the deals, we typically lead the deals, right? So we'll resolve all of that. If there is a very big gap in valuation, we've had to sort of let go of transactions where it's not fit our appetite, right? If you're coming in early, same thing you asked us, right? So because blockchain, NFTs and all are buzzwords, you want to demand a 10 million sort of plus valuation when you've not built anything. It's not something that we can do, irrespective of how our later stage investors might look at it, right? So for us, we'll sort of set the pricing, we can do all of that, but these 2 or 3 parameters is where we typically operate in.
Just to add to that, in case you can't arrive at a price and you still love the deal, just kick the can down the road, unpriced round.
Yeah.
All right. You have some question? Yeah.
Is IPO a metric of success, and what's your view on it? I understand that you want to exit on IPO, but how do you exactly?
Any exit is good.
Given the fact that you look at late to good, I mean, the thing is growth to late stage. I mean, obviously, you would see that if an IPO happens, I mean, that would be the best because typically you'll be entering in at maybe a Series B, Series C, and see multi-fold returns out there. But I mean, the thing is, you only answer how many digital IPOs have effectively happened in India from say the 2 years back to now. You're looking at all of maybe basically 5 or 6 companies that in the digital space have gone for a listing, right? Typically, it is not a criteria to look at it. I mean, of course, it is one thing that an investor or the investor set would actually aspire to have as an exit. But typically, you will see a lot of it happening through large secondary rounds, and that is the truth of the matter. Because if you are, and I think also I would allude to Chiranjeev here because if the thing is, if you enter in early at a pre-Series A, Series A, and the company actually scales up and is able to go to a Series C, Series D, your rights would take it to actually have an exit at that point in time. Because as an early stage investor, you get the preferred rights over the guys who will be coming in later. So in terms of liquidity pref also, you'll be liquidity preference, you'll be having that right to exit out first. In terms of the waterfall model, or whatever you guys, whatever might be the construct of the deal, right? So I think the idea is that a scalable company overall, and if it can reach a reasonable level of say valuation or revenue as per your investing criteria, like you don't see $100 million valuation company going for an IPO. You'll see an investor who invests in a $10 million round of a company will see an exit happening through a secondary round, where another investor would come in and buy his lot of shares, for example. So those are the more likely cases of exits. But your IPOs would be very, if you will find, it's not a key criteria for an investment.
Yeah, and let's be honest, a good IPO ecosystem is good for the ecosystem, which means that you have access to good capital, easy capital from the public. But as a founder, you have to ask this question: is that do you really want to be publicly listed or not? Right? So at the end of the day, if, as a founder, it is your prerogative where do you want to keep the company. Whether you want to keep it privately held or do you want to float it publicly. For the investor, it really doesn't matter as long as the investor has a viable exit. It's as simple as that. So IPO, no IPO doesn't matter for the investor. Give them an exit as hopefully within the fund life, and that's all that matters.
Can you just give a little more depth on the evidence of execution that you mentioned earlier? So you said you wanted to see founders who had some evidence that they were able to execute at scale. So
No, I think Aashish made a very good example. So why don't you kind of for the logistics company?
Yeah. So I was just giving an example that we were looking at the logistics tech company, and the founders actually came from a hardcore logistics background in the sense that they were looking. The thing is, they were working for a sea transportation logistics company. All of them, in fact, were in different divisions of that company, and basically they were able to build their own, or essentially whichever business they were looking at within the logistics company, they were able to scale it up quite extensively. So with that in mind, when we looked at these founders and the way they were building their logistics tech company, we saw that they obviously took best practices of what they had learned in the early organization and are applying to this company, and also doing it very frugally. So you understand that if you're building, if you understand the nuances of your industry you're operating in from your previous experience, you will apply those good practices, best practices, and obviously apply it to your own startup. And so this, like I was just explaining earlier, that this company really stacked up as the top quartile in terms of ROCE, in terms of return on capital employed, in terms of the kind of funds they've raised and the revenue they've reached at, right? So it was very impressive to us because these are the things that we would look at, because if right now they're doing it at this level of scale, and if they raise their next round of capital, they can do maybe a far better job, and hopefully can become a large company that can even go for a listing. Who knows? It can basically be the listed company that they were earlier working for. So that's how we think that execution of this founder set was very impressive to us. I mean, that's how we actually understood it. So that is from my experience.
To your question first, right, which is how do you sort of look at where experience kicks in, right? For us, again, because typically younger graduates, not a lot of people fit that bit, but giving examples, let's say of deep tech or biotech sort of companies that we do, right? PhD graduates or essentially they have that background. They've been working or doing research on this technology for years now, right? They understand the nuances of what they're building. They understand sort of different. We did a biotech company. Sort of the best way to explain it is giving you the accuracy of your RT-PCR test in the time a rapid antigen takes, right? Without the requirement for any sort of offline hardware. But they understand the core technology behind it, right? They've been researchers in this, they can sort of break through something in it, right? So that is where that experience sort of fits in, or we've just done a second space tech company. So this is where all of it comes in. So when we are looking at companies corely into deep tech, this is where it matters, right? Or again, a similar example, alluding to it, but we come in very early, right? We just did a B2B chemicals marketplace company. The founders, say IIT Madras founders, they sort of dropped out and went, but we didn't like them for the IIT Madras pairing. We liked them because they left the institute, went to Ahmedabad, that is the chemicals hub in India, right? Spent 8 to 12 months there on the ground working with chemical manufacturers and suppliers. So gave up whatever potential they had, went on ground, worked with them and sort of understood how that industry works, right? Made that rapport, made those relationships. We obviously spoke to people who they work with and understood is there actually going to work with right? So things of that nature sort of is where it matters to us. In a lot of cases though, the kind of sort of profile of founders we invest in, they might not necessarily have experience in that industry or sector, but we just want to know, we understand the nuances, right? We actually spend time doing some research and being on the ground and figuring that bit out, and it shouldn't just be a wacky idea coming and saying that, hey, I want to do this. We don't do ideas of that nature, right? And just quickly addressing the IPO questions. For us, it is a clause that we can write from our agreement stage itself, but realistically, a far-fetched scenario that we're looking at, right? Like a very, very far-fetched. We potentially say we already have two outbreak sort of companies from our portfolio who can potentially do IPO. We have LPs or investors in our fund who can take the portfolio company through that, right? So HDFC Bank, IIFL Wealth are sort of LPs in our fund. They can potentially do all the subsequent rounds and take these companies to an IPO. But again, a very far-fetched sort of scenario, right? 8 to 10 years down the line. And as Koreel also mentioned, if it's within your fund life cycle, right? That is a very important factor. SEBI changed the regulations that you cannot extend your fund life anymore, right? Endlessly. So a lot of those parameters come into play. But as long as Aashish also mentioned, you get an exit is what we're looking at, right? And you get that reasonable exit to sort of return your funds is what we're looking at.
Yes, sir.
I understand investing is for ROI. What happens to people who want to do social projects without ROI? Without necessarily ROI on the books. I'll give an example. We want drones flying around all of the Konkan area, seeding. Monsoon has started, right? From 1st August till 15 days, we want to send drones out with seed balls.
Impact investors, they typically operate with dual checkbooks and dual purpose. So they look at the double bottom line. One is the impact creation, the social impact creation that you're talking about. And the second is the impact on the financial books. So they will always have a different perspective. So they will not only chase financial IRRs, basically they will not say that I need a minimum of 15% IRR on this investment, but they will say that, well, if it kind of fulfills X, Y, and Z social goals, I'm happy making 5 or 6% also. So you have to identify the investors. So you have to go to an investor who's a social impact fund. There are several out there. If you just Google it, you'll get to know. Secondly, you should focus on this, pool of money, which is the CSR money. And thirdly, you should focus on grant funds, which also provide you with that without any expectation of return. So grant funds don't need returns, CSR funds don't need returns. Both of them you can structure as service contracts where you capture that as revenues and you do your expenses against it, so you are not paying taxes also to that extent. And the last is your impact investors. There are Elevar, Asha Impact, Avishkar, you name it. There are many of these impact investors.
Can I add a point? I think all companies have 3% of their profits as mandatory CSR.
2% net profit.
2% of net profit as their mandatory CSR budget. So every large organization will have significant pool, and every organization aligns themselves to certain causes. Some will align to education, some will align to sustainability or green whatever, global warming, etc. So if you identify the organization which are aligned to your cause, you will know their profit, will know their budget definitely.
I have done the same a CSR project with an SBI Foundation last year on menstrual hygiene. So it was more into sustainable living. So we did a CSR project of around 4 lakhs with them.
At any stage, unless you're a series C, D kind of thing, up till that stage you need mentors.
Yeah.
You will need mentorship. Choose an investor who is more than just money, because if it's only a financial investor, they will also pull the plug the moment their goal is over, or when things go bad, they will want to pull the plug. And again, financial investors are of various varieties. If it's a good, proper institutional financial investor, they will most probably not pull the plug. If it is an individual who's putting money on his own whims and fancy, he will also want his return on his own whims and fancy. So be very careful when you're choosing an investor. But most of all, if you're a very early stage, please over-index on mentorship also, and the network that the investor can make available for you.
Correct.
So it does not mean that the investor will sit with you every day, every week, or month and brainstorm. No. It means that, can you ask him that, I need to be present on all the shelves of, let's say, Big Bazaar or Reliance, whatever. Can you open that door for me? Can you connect me with the purchasing department? That is the kind of investor you will
Correct.
Yeah, so given the space you operate in fact, a couple of companies already there. So that's, that I'm sure you would have heard of Noah Women, Pari, Sirona Hygiene, and
Yes.
and the like. I think off the lot, Sirona Hygiene has had an exit to big, the Good Clan Group. Correct me if I'm wrong, but I think what in this space, what will really help you, especially, is that you have to kind of understand as to how these guys started or what was their business model. Okay, because there was a time, and I think this was maybe 2019, 2020, when a lot of these guys got funded as well, right? It was a craze because typically, you look into a particular space which at that point in time, menstrual hygiene was untapped, so to speak, and there were not. I mean, you had brands like obviously your Stay Free, Whisper, etc., which were so you had either the really large guys out there, right? Typically, who were doing this. And obviously these new age companies were coming out with something, maybe let's say a better material, let's say a better product, etc. Right? So they did get a lot of funding in 2019, 2020, as far as I recall. But then you have to see as to where have these companies reached now and what are they doing differently? Because have they really captured that kind of market share? Are they doing anything more? Are they launching more kind of products within the segments they operate in? Are they launching something besides only, let's say, sanitary napkins, pads, etc., menstrual cups? Are they looking at something else altogether? Maybe that could be a good starting point for you to see where you also want to go ahead and what do you want to be positioned as? Because here it is, what I think you're trying to do is a direct-to-consumer menstrual hygiene brand, right? Typically, basically trying to become that. But all of these companies have maybe reached a significant level of scale and are now competing or outpricing each other, let's say. So you need to understand where you want to stack up against these guys, as well as where obviously Whisper and Stay Free have already reached. Of course, those are like I would say really big names. But from an investor standpoint, you need to look at what kind of investors have already seen this space and what maybe is missing in the other, let's say, consumer-focused fund portfolio. For example, if let's say a DHT Consumer Partners has already invested in this space, obviously they're going to do it again. You might as well look at a new consumer fund which actually has this gap in their portfolio. That might be a good starting point as well for you to look at or to speak to. Because everyone wants to invest in challenger brands or basically trying to challenge the incumbent brands. And so accordingly, you should look at funds in that space who basically have a gap in their portfolio. Right? So maybe a DHG may not be a good fit for you, but maybe a new fund which is consumer focused might be, which doesn't have this type of a company in their portfolio at a good valuation, obviously.
I think he must think a bit differently and out of the box, because there are many competitors in the market who are selling sanitary napkins. So it's more about focusing more benefits rather than the features to the target audience, and a bit different, set himself apart, set the brand apart from the others. That would really help. I totally agree with your point.
Is it possible to have something, or is it already available where investment might not be needed but mentorship is needed for sure?
True.
So responding to that, there are okay, just make sure you get on the my 2 cents here is make sure you get the right mentors or advisors, right? There's a lot of people who are quote unquote angel investors or advisors or mentors in the market, right, across a variety of age groups. There's platforms that help you facilitate that as well, right? I'd say identify the right individuals, spend some time with them, understand how much time will they be spent with you on your business, where will they add value, and then bring on board someone as a mentor, right? They could have great credibility, they could have the right credentials for sure, but will they be able to give you that sufficient time to maybe add value and help you grow your business is a very big question, right? So as investors, maybe his initial point, we'd always say like go after investors who bring in capital, but a lot more apart from that capital as well, right? Because the earlier you are in your journey, the more support you need. I won't call it direct mentorship, but the more support you need in terms of building your business, right? So we also prefer investing in where we know we can add direct value. When I say direct value, take you to different companies, sort of open doors for you across different businesses, or help you sort of align with different strategies. There could be a consumer focus or even a B2B sort of startup, right? But where we can have that direct impact, where we know we can add value with those introductions, is where we know apart from our capital, that is where we sort of push the ball a bit more, right? So always look for investors maybe at the earlier stage who look at that. What I'll urge, and it might not be sort of as intuitive to everyone, is first be sure you want an investor on a capital. It sounds good, it sounds fancy, it sounds that okay, now you can boast about having an investor and having X valuation. It is a lot of responsibility, right? And that is where you're not just responsible for your company, you're responsible for someone else's money, right? And an investor or a VC will expect you to grow, right? Irrespective of whatever it is, until unless it's from a very sorry to say this, from a very well-wishing place saying that look, take 20 years to grow a company and reach wherever. Investors will want you to grow at a certain pace, right? So that you can raise subsequent capital, you can get that jump in value, right? So be very sure that you want an investor, you need an investor, and only then go out and get an investor, right? If you're just doing it from an optics perspective, might not be the best reason to raise capital.
At a point of time, we're like, I just need investments now. And we've seen startups who have raised investments but later just exhausted those funds. So how should someone, a business or an entrepreneur, evaluate whether he or she is actually in need of investments? Is the question asked? Yeah.
There is no right time or wrong time to one startup, two to raise funds, right? There is absolutely no right or wrong time. If you're saying that you're still discovering your business and you'll still sort of understand your business, a lot of VCs are not what we call patient capital. Right? Patient capital typically means that they will give you that time or that leeway to figure things out, to build the business, because same thing we've been saying from an initial perspective, funds have a life cycle, right? That sort of comes into how long can they be invested in the company, things of that nature, right? The point is maybe go out and raise when you know what you're going to exactly do with that capital, right? How will this capital come and add value to your business, help you go from X to 5X to 10X, right? So putting in every dollar should be able to give you 3X, 4X, 5X. So ROC is what sort of Aashish mentioned, right? For every dollar invested, how much can you grow in terms of revenues, or how much can you grow in terms of businesses? Right? That is what you need to look at. And so does that capital come in and help you out directly in that? Or is it just going to be you need capital to sustain yourself, to sustain your business, and then keep figuring things out? Maybe not the right thing, because investors have an expectation of them. Right? And having that added pressure and saying, why haven't you figured this out? Why aren't you sort of building? Why aren't you growing? That's not the right sort of mind frame to be on, that you're still figuring things out as an investor is sort of adding pressure. So that's sort of my thought process behind that.
I think all great points by Chiranjeev. The one point that actually also comes to mind is that when you're looking at a time to raise funds, you I think have to really understand what is the business model is say like as good as set in stone, because as a startup founder you want to do like multiple things and attempt to get multiple sources or channels of revenue, right? You can do that, of course, no doubt, but get your business model really right and clear. And when you are presenting to a VC, or rather when you want to explain it, it has to be really well spelled out in your pitch, because like I'm sure he would know, so like the number of, like the VCs out there are looking at, easily I can throw a number out there, almost 400 to 500 companies a year on average, or maybe at least 300 companies, basically one company a day on average. So they have a lot on their plate. For them to understand that is this an investable company, or it is interesting to look at, you have to get your business model down to the wire perfectly, right? So that is very crucial, because everyone wants to do different things. Besides that, I think what is important is that once you have your business model in place, you have to see a couple of months, maybe years also, in terms of, well, let's face it, it has to be bootstrapped to that extent. And if you know that business model that you have set out, you're able to garner revenue, even though you might be burning money, but if you're getting a, let's say, a reasonable level of revenue, you know, like the rule of thumb is if you're able to get to at least 1 million ARR, like for example, basically, अगर आपका 8 crore का revenue है, you could basically go out and raise your first institutional check. That's a rule of thumb in terms of numbers. Typically, I'm saying, I'm maybe obviously overgeneralizing here, and maybe he can tell me that might look at companies at an earlier stage also, of course, no doubt. But a general rule of thumb is you should touch at least about approximately 1 billion in ARR. Then you can go out and raise, because that's when you know your business model has succeeded to some level. You have obviously product market fit is taken for granted to some extent, and that you have revenue coming in from the channels that you're looking at typically, and obviously team is set, etc., etc. You don't necessarily need to have a sprawling office somewhere on rent. Obviously, that's how typical founders are, and then you can go out and raise. So that is, I would say more or less the rule of thumb, at least in terms of numbers.
Would like to say, ask yourself why and not when. Why do you want to raise money? So if your business, for example, is you have let's say a good product market fit, you're earning revenues, can you as founder, do you as founder firstly value your business and your model? Do you hold it close to your heart or not? If you hold it close to your heart, why would you like to part with it? Right? So ask yourself why first. If that why yields you the answer that, look, I have done this much, but I also want to add one little bit which will perhaps be the growth kicker on top of this and will help me diversify or de-risk, not diversify, diversification is always not the best word, de-risk my current line, then perhaps ask yourself that, okay, if I need that much money, how will I be able to at best return the principal of this? It is very important for you to know that that mathematics of what is going to happen 5 years, 7 years down the line. Typically, a fund that will invest with you will have maybe 5, maximum 7 years left on its life, right? So you have to be aware of where the investor is also coming from and why do you need to raise that money. If you think you can do justice to that, then okay, raise it. But again, ask yourself that where will you then deploy that money? Are you going to deploy that money just to mindlessly hire or get a fancy office or something? Ask those questions. Yes, it's not bad to have a good office, but maybe it's better to invest in something which is more core to the product. So ask yourself many questions before you decide the when. Because once you've answered those questions satisfactorily, you'll find out the when.
So it's not necessarily the tag as well. For us, it was, can they build something in the space they're operating in, right? To your question specifically as to why a lot of, it is a harsh reality of the ecosystem. Yeah. It's changing slowly. I can try and answer in everyone else's behalf, in the sense of other funds' behalf. I know of a few funds who look at pedigree, they won't quote it outright, but understanding their thought process, I'm not saying that it's right or wrong. Everyone has their own investment criteria, right? From their perspective, it is another check in the box, in the sense they've been through a certain rigor, right? Is what the sort of thought process is, that you've been through a certain rigor. I'm an engineer, a non-IITian, right? I never decided to even try and study for the JEE because I'm like, that's not my cup of tea, right? But studying for the JEE and cracking that is not an easy task, is also what I will sort of be very confident in answering, right? So it is that additional set of rigor. You know that they've been through this rigor, they've been through this process. It is just that thing that they're going after, right? And as you go more and more to growth stage, if pedigree is looked at, your early stage investors de facto look at it, right? So it's just nature of the business. Hopefully it changes with time. We are trying to change it, but that would be my best response. And let maybe Koreel or Aashish sort of respond to that. And sorry, to your question, so in terms of what's the right number, there is no right number. You've done 5, you've done 1 as well. I know a lot of funds though that say that look, anything more than 3 is not, it's too many heads. Solo co-founders as well, I've heard of funds not being too comfortable, right? The way we look at it is, if you're a solo co-founder, what do you understand in the business? What are your core capabilities? And can you build that team around you, right? You can't be a jack of all trades being a solo co-founder. You might be great at business or great at tech or maybe great at marketing and finance, right? But can you bring in those sort of support systems to come and build out with you is what is most important, right? And you need to know what to delegate, what is not your cup of tea, and give that responsibility to someone. You cannot hold everything close. That is in terms of a solo co-founder. In terms of multiple co-founders as well, right? Clear responsibilities, who handles what, but for us, what is, we outright ask, who is the CEO? Who do we go after and ask that, hey, look, everyone, you might be a CTO, CPO, CBO, whatever you want to call it. Who is the CEO? Because eventually if anything goes wrong, the buck stops at you, right? The decision making is up to you. Everyone could be on the board, you can structure things however you want, but the CEO is responsible for growth or answering in terms of if governance, anything goes wrong, right? That is how we try and look at it. So there is no right number, at least. You can't decide anything on that front. It's just you putting in your lens and sort of building it out with that.
Yeah, I'll just so I think, you know, to answer your question, in fact, on I think a lot of investors are paying more importance to the fact that, you know, these founders, if they've actually come from the industry in that sense. So I'll be honest with you, like we were looking at a logistics tech company, and all the 3 founders actually met each other in a logistics, you know, company, one of the big ones, you know, like a DHL or the gateway terminals in India. And so basically all of them have worked their way up to, you know, respective roles in that logistics firm, and are now basically starting out and have actually built a company which is in the logistics tech space and is doing excellent work. In terms of, if you ask me, in terms of the sort of, and because this is also from experience that I've seen, in terms of ROCE, actually that company stacks up number 1 because they raised the least amount of capital and are actually having the same amount of revenue that the other logistics tech players are, you know, like having. And all of these 3 founders are non-IIT, absolutely non-IIT, good engineering schools, but completely non-IIT. So I think investors have actually now started giving importance to the fact that would these founders actually have the relevant experience to scale up the business they're starting? That's more important if you ask me. And you know what, honestly, if you see the kind of unicorns out there, and or whatever the companies that have raised those kind of rounds and are now unicorn valued, right? You see the kind of, you know, like the founders they have, they're burning a lot of money without having any idea whether the next round will happen or not. And all of these, I would go so far to say a lot of these will have down rounds. And they're all IITians. But the ones who've been able to scale up slowly and steadily are the ones who are not necessarily from those schools. And if you see, those are sustainable businesses, and now the thought process has changed towards looking at these founders and these kind of businesses. So don't go by what you may have seen in the past. Like he said, I think it is slow, but it is changing. Definitely changing, because they will see the experience first. If these guys can actually scale up the business, so that's like my 2 cents here.
I mean, both of you have added excellent points. I would say that I think the mindset amongst a lot of the older established VCs is that you don't get fired for hiring an IBM or an EY, right? For your stuff. So therefore you don't get fired for putting money into an IIT. So, but having said that, none of our companies, we have a global portfolio in any country, is any of the founders from a top 5 school. Nowhere. Within our team, we do have a preference for good institutions, but when we invest, we have no such biases at all. And I think one of the main things we look at is just prior experience of execution. That's it. Execution is the only thing.
Essentially, I think the question is, when you're bringing on a capital investor or financial investor externally, what is the ratio of returns or sort of profit share that you have or you sort of owe? Or I won't go to valuation. That's a very long discussion. That's a very different conversational topic, right? Maybe just setting base too in terms of, and I'm hoping I'm sort of answering for everyone here, but in terms of external investors, when you typically come in, or as VCs, right, when we come in, we typically do not take any share in the profits out of the business for a certain period of time, right? So if a company is profitable, let's say generating 10 crores in, even 10 crores in profits a year, right? As long as no profits are distributed to anyone, the investor cannot and will not ask you for a financial return unless it's structured very differently at the time of investment, right? In most cases, if not all, you do not draw a share from the profit for typically a 4 to 5 year period, right? After which your returns expectation typically kicks in, right? No right number to what are the returns that you expected. After the 5 years, typically from an agreement or from sort of a contractual perspective, investors would kick in saying a 25 to 30% IRR, right? That basically means 25-30% compounded over a 5 year period, right? That is the expectation after a 5 year period. Internally, as investors, whenever you invest, you typically expect sort of a 10x return on your investment, right? As Koreel also mentioned, as founders, you need to think at least can you return the basic principal back, right? So there is a wide range that will typically come in. But from a capital or a liquidation perspective, right, from let's say a purely theoretical perspective, VC is an illiquid asset class, right? So we cannot exit, like in capital markets, when you're investing in a public company or investing in shares, right? Tomorrow you see the share price fall, you can be like, nahi, I want to exit, right? You can exit. We can see our companies burn money on a day-to-day basis, and you cannot control or you cannot sort of say that no, tomorrow I want my money back. That's not sort of a privilege or sort of a facility that we sort of kick in. That's not something that's typically there, right? So it's an illiquid asset class. You do not take out any capital from the business. That is the nature of this sort of investment. But
yeah, I guess I'll just also take one point ahead is that typically, like to answer your question, in terms of returns, what the investor will obviously see is what is his cost of capital firstly. So as you know, I mean obviously equity cost of capital is higher than cost of debt, but equity cost of capital, if let's say for an investor, is about 10%. He will be expecting on average about 18 to 20%, as an IRR to basically justify the investment to his investors, right? To his LPs in that sense, or his group of investors. So typically rule of thumb is that if you're able to get about say 15 to 18%, that you're home basically because you're more than your cost of capital. And like he said, that it's a very illiquid asset class, right? You have to wait for a number of years. It's not unusual to expect returns happening minimum 5 years, I would say. Typically, if I take a median, would be, or like median and average would be at least 5 to 6 years.
Nothing is beyond negotiation. Legally speaking, nothing is beyond negotiation. You can sign something, you can always have addendums to that legal contract later. So, as a founder, approach it from a point of view that today, this is the scenario that I'm aware of and I'm signing this. But 4 years down the line, who's seen what's happening? Maybe even that fund manager won't be around. There's somebody else doing that, managing that portfolio. So nothing is beyond negotiation.
So the direction in which we are going now is, and because of some words which we use, which is principle, and why would a founder want to part with his organization? What are the innovative ways where people who are looking to build an enterprise can still raise capitals without having to part with equity? And we know like Royal, so we are aware of the Shark Tank kind of deals, but do they happen in Indian ecosystem also? Because Indian sharks haven't done that so far. Something like this.
The royalty type.
Either you do debt
Factoring is one of the ways. If you have a good B2B business, if you have a good B2B business and you have predictable invoicing and that pattern of predictable invoicing with large clients, you can do factoring.
Which is invoice discounting.
Yes, yes. Or Aashish has done a lot of similar things.
Yeah. So I would just like to caveat that equity capital or like equity investing is not the end all and be all of it. Firstly, let's just put it out there. Okay. It obviously offers a lot of let's say strategic support, operational help, etc. But if you have a company which is actually doing well from the get-go, it's actually not burning money, you have a reasonable profit, this thing like PAT, reasonable EBITDA, whatever. you've got like a healthy balance sheet, so to speak, it's okay to go on and take on some debt. It's fine. If you know what your business needs, let's say for example, okay, bhai, I need money for working capital. You do not need equity capital for that. You need to go to a bank, which also, like a lot of these banks nowadays have new economy divisions. So they will basically lend you, let's say, a line of credit for working capital. That's okay. You don't need to go for equity capital. It's not, let's say, it's not needed in your business. So you have to understand what use cases are there in your business for which you need that kind of funding. So if it's working capital, then yes, you need debt. If it is even say, let's say acquisition financing or asset financing, again you need debt for that, right? But if it's saying that you want to build up your product or your tech stack, or you want to have an operational team as well to support you towards that, then maybe the use cases would be more geared towards equity. You may need equity capital because it comes with, like I said before, some kind of strategic support and helping you to reach that level. But if your use case is very simple, okay, by just basically debt can serve that, then go ahead for that. And in terms of innovative means of financing, nowadays you have revenue-based financing, which has just come about in the market. I would say the last 3 or 4 years, in which the revenue-based lender would not need you to have equity capital. Firstly, you can just basically say, again, I have to allude to maybe a D2C brand in which you're getting regular revenue from your base of customers, right? That will be, let's say, escrow to a particular account in which the first lien or charge on that account, or rather the first kind of payout, will go to the revenue-based financier. So let's say that financier will take 5 to 6% on a month-on-month basis of your revenue that's coming in, and then everything would be after that your operating expenses, and then basically leading to your EBITDA impact. So the point that I'm trying to make here is that even revenue-based financing is a good option for those kind of companies which are seeing stability in their business and have stable cash flows, for example, right? So you don't necessarily need equity all the time. Now coming to venture debt is a different asset class in which venture debt would only come after your equity capital has been raised, right? So typically venture debt is complementary to venture equity. So venture debt, again, use cases are typically, it's for general corporate purposes. So it is a cheaper cost of financing to venture equity, and can be used for everything which even venture equity can be used for. So that is an asset class which is also scaling up quite extensively. But obviously the cost associated with venture debt is higher than what you might have if you're, say, taking a working capital loan. So you have to understand particular use cases and accordingly go for that. Attempt to get a lower cost of debt, obviously. But the typical rule of thumb is venture debt, you'll be paying anywhere between 14 to 15% as a coupon rate. And then obviously you can work out your EMIs and understand how to go from there. But that's a general rule of thumb.
Nothing, not a lot more to add, right? So it's typically non-dilutive is only debt, right? It's typically on that front. Debt again has multiple ways that you can look at debt financing. Like you said, venture debt is upcoming in the country, right? Still fewer number of venture debt funds, but still upcoming growing sort of fund sizes of that nature. Innovative sort of debt financing, in fact startups are coming up, right? Like you mentioned, revenue-based financing, factoring, invoice discounting, there's a lot of startups coming in. Asset financing and asset-based financing as well, right? So if you look at, let's say, Leaf Round, if you look at Grip, there's a lot of these startups coming up, corely focused on startups or other stable businesses. But like Aashish also mentioned, right, you need to understand at what stage your business is. If you are sure you have a healthy bottom line, or your sort of books can handle sort of paying returns out on the debt front, and you don't want to dilute equity, by all means, there's a lot of innovative financing sort of structures coming in from short term to the long term, right? Banks are in fact becoming more and more open to this. They're trying to become more mainstream. There's a very interesting thing, I don't know if you folks know. So Cred Mint, right? It's broadly P2P lending, but for businesses, right? So investors like all of us here can pool in some capital, and then the intermediary will sort of finance other companies based on that. As financiers, we get a certain return, they charge sort of a markup, right? So a lot of innovative things coming in. The startup of the company does not dilute any equity in all of these scenarios, right? But do it only in the scenario you can handle that added load of debt. It is not going to sort of turn your company very liable to things, right? Because debt or creditors have first rights on everything in your company, right? So if you cannot pay the books, they will come in. I mean, there's a lot of ways it can go wrong as well. So as long as things can go, you can handle that load. by all means, that is a great way.
मैन्युफैक्चरिंग बेस्ड स्टार्टअप है, जैसे कि एडेबल टी कप का मैन्युफैक्चरिंग करता हूँ। एडेबल टी कप, जैसे कि चाय पीने के बाद ना खा सकते हो। तो मैंने सोचा कि मार्केटिंग ऑफलाइन से किया जाए या ऑनलाइन से किया जाए, तो आपका क्या कहना है? एडेबल जो टी कप है उसकी मार्केटिंग ऑफलाइन तरीके से करना चाहिए?
इसके बाद डेमो करते हैं। सो इसके लिए आई थिंक आपको थोड़ा सा नॉन ट्रेडिशनल मार्केटिंग अपनाना चाहिए, जैसे कि आप सिर्फ एड्स मत करिए। कर्नाटका में आई मीन आप अगर वहाँ बेस्ड हैं तो एक कंपनी है द बेटर इंडिया नाम से, वो जो है इस टाइप के प्रोडक्ट्स और स्टोरीज को कवर करते हैं, और वही खुद जो है कवर करके वो लोग उसको प्रमोट भी करते हैं, और वो लोग जो है आपको एक जरिया भी देंगे रेवेन्यू अर्न करने का, क्योंकि वो एक कॉल टू एक्शन लिंक लगाते हैं कि आपका प्रोडक्ट बेच भी जाए। तो अगर आप चाहें तो thebetterindia.com है वेबसाइट, उनको आप कांटेक्ट करिए कि मेरे पास ऐसा एक इनोवेटिव चीज़ है। उन्होंने पहले भी ऐसे कप्स एंड प्लेट्स मैन्युफैक्चरर को कवर किया हुआ है, तो एंड उससे उस मैन्युफैक्चरर को काफ़ी सारे नए ऑर्डर्स वगैरह मिले हैं। तो आप ये ट्राई करिए, बिकॉज सिर्फ ऑनलाइन एडवर्टाइजिंग वगैरह करने में आपके पैसे बहुत जाएंगे, और उतना जो है कस्टमर एक्विजिशन शायद ना हो भी तो वो थोड़ा सा क्या कहते हैं लंपी होगा। आई मीन जिस दिन आप एडवर्टाइज करोगे उसके अगले एक हफ्ते तक आएंगे लोग, फिर बंद हो जाएगा। सो आपको उसको अगर आपको वो करना है, थोड़ा सा स्मूथ करना है, तो आप थोड़े से नॉन ट्रेडिशनल मीन्स से करिए। थोड़ा स्टूडेंट एम्बेसडरशिप देखिए, कॉलेजेस वगैरह में जाइए। स्टूडेंट लोग जो है काफ़ी वो होते हैं, उत्सुक होते हैं कि कोई नया चीज़ ट्राई करें, वो चाहते हैं कि एक सोशल कॉज के साथ अटैच हो जाए, तो उनको आप एंगेज करिए। और ऐसे तो कर्नाटका में बहुत कॉलेजेस हैं, तो आप अपने एरिया के आसपास से स्टार्ट करिए, और धीरे धीरे वो एक जो है बढ़ता जाएगा।
ज़्यादा वॉल्यूम्स आपके कंज्यूमर्स मे भी नेसेसरली नहीं खरीदेंगे। बिजनेसेस पकड़ लो, सीसीडी पकड़ लो, कोवर्किंग स्पेसेस पकड़ लो, डेवेक्स की तरह रहे, वहाँ पे ज़्यादा कंजम्पशन हो सकता है। तो rather than मतलब ऑनलाइन मार्केटिंग पकड़ लो, रीजनल मार्केटिंग इज एक्चुअली अ नाइस वे, बट डिस्ट्रीब्यूटर्स के पास या अगर आप डायरेक्ट बिजनेसेस के पास जा सकते हो, राइट, जिनका कंजम्पशन एक कप्स मल्टीपल क्वांटिटीज में होगा, राइट। सो आपको जाके एक कंज्यूमर नहीं लेना है जो मे बी एक महीने में एक खरीदेगा, राइट। आपको जाके देखना है कि एक बिजनेस अगर खरीद सकता है मल्टीपल क्वांटिटी एक साथ, राइट, तो आपके बिजनेस में वो रेवेन्यूज आएंगे, आप फिर और प्रोड्यूस कर सकते हो, और मैन्युफैक्चर कर सकते हो, और जाके डिस्ट्रीब्यूट कर सकते हो, राइट। तो बिजनेस साइड पे मे बी और देखो कि आई डोंट नो, अगर आई डोंट नो दिस सप्लाई चेन, सॉरी, कि यहाँ पे डिस्ट्रीब्यूटर्स आते हैं या कौन यहाँ पे खरीदता है नेसेसरली, बट अगर कोवर्किंग स्पेसेस से पकड़ लो, राइट, डेवेक्स में भी अगर लमसम में खरीद सकता है, बैनर डाल सकता है कि ये सॉर्ट ऑफ सस्टेनेबल कप है, वो सॉर्ट ऑफ अप्रोच आप ले सकते हो, और राइट, दैट मतलब दिस इज व्हाट माय थॉट प्रोसेस।
हम लोग मार्केटिंग एक्सपर्ट्स नहीं है, तो इतना ही।
कंपनीज लाइक यू सेड ना, इको का वो लोग ये करते हैं, आई मीन CSR के लिए, तो उनके उसके ऊपर भी अगर फोकस करके उनके साथ टाई अप करके, अगर companies, so when companies take, they will take it for internal consumption and they will speak about it also. So what happens is he will get his reach also, and at the same time he is able to sustain himself because उसका big भी है। तो दोनों तरीके से, and if he can give an idea about the comparison between अभी जो cups use किया जाता है versus his cup, कि benefits plus the cost का भी एडवांटेज मिल गया, तो ही इज टेकन केयर ऑफ, हिज बिजनेस इज टेकन केयर ऑफ जस्ट बाय इवन स्टार्टिंग ऑफ विद वन सिंगल कंपनी। लाइक फॉर एग्जांपल बिग बास्केट, दैट आइडिया वाज सो गुड that Tata took it up. So there are so many, this is soul, that food, that some soul kind of ऐसा एक था soulful or something, that was again bought by Tata. So something like that, if you really can connect with a company which has got a good conscience, the company has to have that conscience सिर्फ उसके साथ वो जुड़ गया तो इसका तो ये स्टेक 1 से शुरू किया तो हो गया.
Again, there's one more angle which we can also explore, sustainability, because there will be no garbage and environmental angle. Yeah, so that is also.
I have one idea. आप मुझे offline करिए.
थोड़ी देर में now one. We have some demos. I know some of you have got your products also. So now one thing, as a moderator, I would like to inform all of you. Like in 10 minutes, we'll wrap up this and then we'll all connect with each other. Before that, one instruction. We have a WhatsApp community. Some of us are like regular people here who do this. So you can just join the community for further updates also. We'll also be sharing the photographs and videos on that particular group. We'll share you the QR code. You can come to myself, Vishal sir or Nirav. All three of us are here. Secondly, I know you have a lot of questions. In case it is very specific, please go one-on-one with the experts. And yes, we also have to share a lot of visiting cards and all. So be ready with those, okay? हंसो यार, तुम लोग इतने सीरियस क्यों हो? Okay, so I have one question from ma'am and one from you, sir. Alright, so.
No, I wanted to add on to it.
You want to add on to it? Would you allow?
Basically, if we could start with college institute, college educational institutes and schools, because what is happening is every student wants to try something different, new, and then after a period of time, he could just gather a feedback. And that would help him improve the quality, the taste of the cup and move ahead further. Because what happens in corporate world or even in a co-working space is a really brilliant idea. But then people really don't have the time to really move on with the feedback, and students and college doing students, they really have that energy, that enthusiasm to try something new, and they have that time to discover the good product, how they could improve with the taste. So that would help to enhance the product.
Firstly, I would like to add one
वीडियोस बनाइए, 1 मिनट 2 मिनट के वीडियोस बनाइए, नीचे फ़ोन नंबर दीजिए, that will work. रील्स का मार्जिन्स देख लीजिए, ऑनलाइन अमेजॉन ऐसा तो 18 to 20% वो ले लेगा. आपका कितना एबिटा बनती है, मार्जिन्स कितना बनती है, उसके हिसाब से आप खुद डिलीवरी एजेंट है वो डिलीवरी उनसे टाइप कर लीजिए. और चाय पे चर्चा एक बड़ा चेन है, उससे एक टाइप कर सकते हो, यू स्टोरी में डाल सकते हो, ऐसा ट्राई कीजिए. एंड रील्स 1 to 2 मिनट, किसी को पैसा दे दिए, वीडियो बन जाते हैं, वो वायरल हो जाएगा.
All right, thank you. Yeah, we'll take this case specifically on offline mode. Let's come back to the investment side. So, yeah, ma'am.
Basically, one thing. My name is Akshara, and I am a founder of Agasa Sustainable Kids Sustainable Clothing. So, basically, I would like to add one thing on that. So, what he can do is he can, go to the schools and add something like, we are distributing for 100 members. The initial what he can do is like some ice cream with it. So then people would definitely get attracted with that, and definitely they would come. How to take it forward, I'm facing an issue.
We'll take this offline. This is a little marketing related question. In case you have anything specific to the expertise that we have right now. Yes.
Question. Often I've been heard and told by investors, what have you invested? I have worked with my startup for the last 2.5 years, and I come from a similar background. My startup is connecting the threads between the craft and the modern world. So we are trying to bridge that gap, and we are also using craft for a mental wellness. So when the investors are saying, what have you invested, I don't know what answer to give it, because what do you mean by investment? Does it mean just the money, or what does it mean? And I have been also told by some senior investors, probably you haven't come across the right investors or a seasoned investors. So please elaborate.
I'll try to attempt this answer. Not every business needs huge amounts of capital to be invested. Some businesses are very asset-light. I think if the business can be asset-light and actually yield results, both revenue and profitability-wise, it's a good business. And not every business needs to be hugely scaled. Some businesses can be small and yet be very well run, very efficient, very profitable. So I don't know. I mean, I think it's a case, you're right. At the end of it, you said you haven't met the right investor. It's a case of beauty lies in the eyes of the beholder. So that's how maybe some investors' hypothesis requires them to invest in businesses like this. For them, it will be a good business. But some investors may be not looking at smaller scale businesses like this. For them, they are only coming in through the traditional prism of evaluation. So you'll have to kind of wade yourself. I mean, I don't have a specific answer.
I'm not only talking about money, but I'm talking about the time and the energy and the effort what you are talking about.
I'll pass on the difficult part to these guys.
So is the reason, doesn't it come as an investment or is just the monetary?
I mean, what is measurable, both are measurable, but at the end of the day, if you're asking for money versus money, it's apple to apple comparison, right?
True, money versus money, but it cannot, suppose if I have just started my startup just last month or something, probably I won't come with the same way, right? And then if you ask me this question, I can understand. I mean, what you have got on the table? You have just had an idea and you're here and you're saying you want to raise fund. But 2 years, it's not easy to sustain when you're making no money, right? It's just not the money, it's the lot more than
I don't have an answer, ma'am, sorry.
No, I will try. Your view.
No, I think at least from an investor standpoint, it's just to see that if you as a founder have enough skin in the game and have put enough capital to see this company through. So it's like, see, the thing is, always remember, when you're speaking to an investor will view you, it's basically like a marriage of equals. They attempt to, they at least say that, but they also want to understand that whether you can be, as an investor, a good support to the company, and the company founder also basically adds some value to the investor. It works both ways. So they will also understand, okay, fine, is this person really vested in this business? Is he or she actually putting his, like you say, the time, the time, effort, and the capital as well. I mean, let's not kid ourselves. It is very difficult for a company which has zero bootstrap money to raise institutional capital. It's just not going to happen.
It's not possible.
Yeah, it's not possible. I'm saying that's a whole different. So then they understand. Okay, fine. If you have actually put in your, let's say, own money, if you've raised through friends and family, if you've raised maybe some kind of debt, and then you're coming to an equity investor. So they want to understand how far you've gone by yourself. If you can actually sustain the business when there is lack of capital. So they want to see that. Because see, there are obviously good times, there are bad times. Now today, I'm sure you've all heard of the funding winter, right? So last, like I think it's last year, even up until now, you see basically VCP funding, and correct me if I'm wrong, that it's almost down 60, 65, maybe 70% from last year till now, at least H1 that we've completed, the first half of the year. So not every good, what we think good startup is also getting funded. So they have to rely on their own means of capital, the founders' means of capital. That's when you see the real founders' grit and ability to also basically weather this kind of a storm. So to answer your question again, I think it's just what the investor wants to see the founder actually, do and basically have enough of skin in the game. That's just what I've put there.
And from what little I've heard about the type of business, maybe going to a traditional investor is a bad idea.
What everyone is sort of mentioning is what is your skin in the game, right? Have you made that effort to go and find out alternate modes of capital, or are you taking the easy way out, saying that look, VCs are present, investors are present, they're financial investors, let me just go and ask someone for the capital, right? They're more so trying to understand from that perspective that have you fought tooth and nail to ensure that a company is there, a company is surviving, a company is growing, have you sort of, and friends and family is a common way, right? So the profile of founders that we invest in, we've seen a lot of younger founders do crypto trading or do service businesses on the side, earn a few lakhs and invest that early on in the business, right? It's not a requirement. That's in no way what I'm sort of alluding to. I'm just saying that it's nice to see that they've gone out of their way, want to do something else, to have that business sort of mindset or that entrepreneurial mindset, to take that whatever capital that you've built, right? As a student, you're surviving on 1,000, 2,000, 3,000 rupees a month, right? But take that extra capital which you would have gone out and partied, but taking that into building something, it's a great sort of heuristic answer for us to look at, right? So it's more so from the heuristic angle that I would think investors are trying to understand, are you really invested in a business? Or do you know we have capital and we can just give it away? We can't just give it away, by the way. But is that your expectation, right? Because at the end of it, every investor has a fiduciary responsibility, right? It sounds great to know that, look, we have capital, we have to invest in that. we are answerable for that capital, right? So at every point in time, our investors are asking us, why did you invest in this? How is this doing? Great, when things are going well, everyone is happy, right? As soon as something goes wrong is when you're asked. So you could have 10 companies doing well, but if that one company is crashing, you're still going to be asked about it, right? And you have to have a justified answer for it. And it goes from why did you invest in this in the first place, right? At that point in time, every question is, why did you invest in this? And you have to have a strong answer for it, right? So it's about just making sure you have all of those pieces.
Yeah, as in Zepto, there is a investment company like Y Coimbatore.
Yeah.
So they back the investment right now, and this year would be the most drastic year. This was from the past years. So investment companies are not investing so much money this year in e-commerce segment.
So I'll tell you, quick commerce segment basically is about. So what they claim to say is that they're 25% of the overall e-grocery market, and they've obviously caught a pace. Of that 25%, 6-7% is the Zepto's market share, which I believe is 1/4 of the overall quick commerce market. You have these incumbents also, which obviously there's Big Basket, which also has a quick commerce vertical which they've started. Yeah, there's Instamart, but Instamart not exactly quick commerce in terms of time, but they're still about 15-20 minutes. So I basically Blinkit also so position themselves as under 10 minute or 10-minute max grocery delivery time. But what word is there on the street, or what we've seen basically people speak about, including the Dunzo founder when we met him, he categorically said that quick commerce is there. Whether it exists in the future is remains to be seen, because it's not a very strong mode, honestly speaking. Because according to him, in your major cities, hyperlocal markets, if you're looking at Mumbai, Delhi, Bangalore, if you're looking at Chennai, for example, the traffic situation just doesn't enable you to even have that delivery, even though you'll be having a superior, let's say dark stores. You'll be having obviously your logistics is going to be a huge challenge to actually get over. No matter what, a 10-minute delivery is just not sustainable as you reach scale. So according to the Dunzo founder, he said he doesn't want to enter the business because he doesn't see economics working out. So if you ask me, as an investor in Big Basket, though it's a part of their business, it is not core to their business, and it could be a good to have but not a necessary to have. So these models may have worked out in the West when you've got clearly defined supply chains, you've got ease of traffic situation generally in developed markets, not in developing markets like India, if you ask me. It's still a while away. So I think Zepto, if you ask me personally, I think is early to the game.
I think again, when you're building something as a founder, thinking of building something, you must have a very clear idea of where does the economic franchise lie. It will lie in something which people need repeatedly and will pay for. Number two, it should not have a close replica of it in the market. And number three, it should be in a space where there is no clear, there has to be absolutely regulatorily clear, and price-wise nobody can punish you. So I think if you have to firstly focus on these three things and resolve that first. The way I hear it, there are already many people doing it, or you are just adding on to one perhaps element which might be you feel that is missing. But I would suggest that you should do more research on this, because does the customer really want, you're saying fashion, right? Does the customer really want quick commerce in fashion?
Yes, exactly, because the market, and if you watch the Zepto and Blinkit, they have already set the opinion in the customer's mind that people want, they are adapting the quick commerce segment and 10-minute delivery. And we
but as a sustainable long-term business, you have to answer the question, is it something that is necessary or is it just a want?
It is the future, because in future, we would require everything in a minute. Exactly.
I doubt it. I doubt I'll need a t-shirt in a minute.
Can I add
Exactly.
something to this?
Because why don't
Yeah, so I'm saying just do more research. I'm not trying to diss your idea or anything, but do more research, I would suggest.
I would just like to add, one hand we are talking about sustainability. On the other hand, we are talking about we need the delivery of a fashion goods in 10 minutes. I don't know, I don't think so it syncs up.
And as far as I know, people take time in shopping. They have a lot of choices. So
like if you go to
yeah. Let's please humbly requesting you to please take it offline, because I want to respect time. Thank you guys for being here. Nirav and also Vishal sir for coordinating everything, because today's event we were expecting a little lesser crowd, but we got a humongous crowd I can see, and they have actually taken up effort to manage everything. So thank you. Apart from that, also Jatin, the founder of eChai, thanks to him for organizing this wonderful venue for us, giving us this opportunity to share our ideas. And yes, definitely I look forward to all your visiting cards and look forward to connect with you along with you guys. So thank you very much. It was a pleasure to connect with you all. Thank you.